Assignment 2 is called Commencement of Employment and is focused on employees starting during the year on either an emergency or week 1 month 1 basis of tax. An important part of this assignment is the process of moving from an emergency and or week 1 month 1 basis to a cumulative basis of tax and calculating any refunds due. So, let's get started. The first concept to be aware of is the RPN. This stands for Revenue Payroll Number. The RPN was brought in as part of a revenue payroll modernization in recent years, and it links to an employee's details including tax credits, standard rate cutoff points, previous pay in the current year, previous tax and USC paid in the current year. The RPN will also indicate if the employee should be on emergency tax or a week 1 month 1 basis. It is important to get an updated RPN from Revenue when an employee starts for the first time. This can be automatically downloaded to a payroll program or downloaded manually from the Revenue website. It is important to know if an employee who starts employment should be on a cumulative basis or a temporary tax of some kind. The reasons to put someone on emergency tax are as follows. 1. For some reason you have not received an RPN for the employee. You are therefore missing all the relevant information such as the employee's SRCOP and tax credit, as well as their pay and tax to date. 2. If you do not know the correct PPS number for the employee, you cannot be sure you have the correct details, so again they should be put on emergency tax. 3. If the employee is not yet registered for tax, then they will not be on the system and should be on an emergency basis. One of the details missing for an employee on emergency tax is their SRCOP and tax credit. In previous years, an employee on emergency tax was given a basic SRCOP and tax credit, but in recent years the tax credit has been removed. The basic SRCOP remains in place, but only for the first 4 weeks of emergency tax. The fact that the tax credit is not allowed typically results in a higher tax than normal. From the 5th week onwards, the SRCOP is also denied, thereby leaving the entire gross liable for the higher rate of tax with no reduction for any credits etc. If you do not have the employee's PPS number, then there will be no SRCOP or tax credit allowed from the very first week. So, as you can see, it is in the employee's best interest that all the required information is with the employer as soon as possible after commencement. However, once the employee is moved to the normal cumulative basis, any extra tax paid will be refunded. In this sample TDC, you can see how the emergency tax is applied if the employee remains on it for 6 weeks. And in this case we do not need to consider any previous pay or tax. The USC emergency calculations are quite simple. The gross is all calculated at 8%. The USC is applied to the tax deduction card as usual, and the PRSI is also calculated in the usual manner. Take some time now to do at least one practice emergency tax scenario. A week 1 month 1 basis of tax is where each week is calculated as if every week is the first week of the year. There are no cumulatives. The most likely scenario where week 1 month 1 is applied is when we know the cutoff point and tax credits, but do not know the previous pay and taxes. To calculate the taxes owed, the employee's actual cutoff point and tax credits are used. Each pay period is treated like the first period of the year, which means that there are no cumulatives, so there are no refunds. This is an example of a week 1 month 1 tax deduction card with 6 weeks calculated. And this is the corresponding USC card. As you can see, every week looks like the first week. The completed tax deduction card shows that the PRSI is completed in the same manner as usual. Take some time now to practice at least one week 1 month 1 tax scenario. Now that we have practiced the relevant concepts, it is time to put it all together and see how it is examined in Assignment 2. Assignment 2 consists of 2 new employees, both of which start in the middle of the year, but with different circumstances. One of the employees will have worked elsewhere in the current year, and the other employee will have not. One of the employees' wages will be calculated on an emergency basis for the first week, and the other will be calculated on a week 1 month 1 basis for the first week. For the employee on emergency tax, we will transfer their pay and tax from the emergency week to their cumulative TDC, and then calculate the following weeks on a cumulative basis. For the employee on week 1 month 1, we will add together the pay and tax from previous employment and from the week 1 month 1 period and transfer to their cumulative TDC, and again calculate the following weeks on a cumulative basis. During the assignment, you will be given details on one of the employee as follows. You will be given the week of the year when the employee started with and the gross pay they will be on, in this case week 22, and a gross of $800. In this scenario, we do not have the employee's RPN, but we do have his PPS number. For the first week only, the tax and USC deduction cards to be completed for this employee are on an emergency basis. For the purpose of the assignment, you will presume that you only got an updated RPN on week 23. The RPN details, including the weekly tax credits, SRCOP and USC cutoff points, will be displayed on the cumulative tax and USC deduction cards provided as part of the assignment. The tax and USC deduction cards will then be completed for the employee or on a cumulative basis for weeks 23 and 24. Please be aware that we are using weeks 22 to 24 for this exercise only. The actual assignment will be based on some other week and a different gross pay, and it is vital to identify both of these early in the assignment. So, the first step is to calculate week 22 on emergency tax as shown. The USC figure was found by completing the emergency USC card. To organize the transfer of the figures from the first week, we can use a transfer sheet. The gross pay of $800 and the PAYE deducted for that week are entered in the transfer sheet. Likewise, the USC figures are entered in the appropriate boxes. These figures will then be entered in the cumulative cards. Looking at the cumulative tax deduction card, you can see the figures from the transfer sheet have been entered on week 22. You will also note that no calculations are done on week 22, the calculations start on week 23. Having all the previous gross pay entered in week 22 allows us to get the cumulative gross pay in week 23. Likewise, having all the previous tax paid entered in week 22 allows us to get the cumulative tax and tax deducted this period for week 23. In this case, you will notice there is a refund for week 23. The calculated tax for week 23 is $320, but the tax credit is over $1,400. Therefore, the tax credit wipes out the tax payable. The previous tax paid of $256.80 added to the calculated tax is also less than the tax credit, so the previous tax paid can be refunded. In this case, the calculated tax for week 24 is also less than the tax credit, so again there will be no tax payable. The emergency week figures are also entered on week 22 of the USC card. Again, having all the previous gross pay entered in week 22 allows us to get the cumulative gross pay in week 23. And the USC paid to date allows us to calculate the USC deducted this week. In this case, the cumulative USC for week 23 is less than that paid to date, which results in a refund. USC becomes payable again in week 24. It is important to remember that refunds are added on to the gross rather than being subtracted. In the assignment instructions, there will be more information provided for the employee on week 1 month 1 than there was for the emergency employee, as they will have worked elsewhere in the current year. We will need to add the details from the previous employment to the first week they were with us and the totals brought forward to the cumulative cards. Again, you will be given the week of the year when the employee started with and the gross pay they will be on, in this case week 22, and a gross of $900. The SRCOP and tax credit are given, but the gross, PAY and USC to date are unknown. This information will be given in a table format. The first step in this part of the assignment will be to complete the first week for the employee using the information given in the previous table. Complete the TDC and the USC cards on a week 1 month 1 basis. The next step is to combine the pay and tax to date figures with the figures from week 22. We will have been given the updated RPN figures, again in table format. This will include the gross pay, tax and USC from previous employment, in the current year. The transfer sheet is very useful to organize the figures before transferring them to the cumulative cards. As you can see, the figures from previous employment have been added to week 22, and the figures in the total boxes will be brought forward to the cumulative sheets. Once the figures are inserted in the cumulative sheets, week 23 and 24 can be completed as usual. Likewise, the USC can also be completed. The final part of this section is to prepare a statement outlining the calculation of the net take-home pay for each employee for the final week. The statement should include the total amount of statutory deductions and net pay as shown. That brings us to the end of this section, and it is now time to practice some sample exams. Your instructor will provide those during the next class.